Welcome to Kaiser Watch with John Kaiser. I'm your host, Jim Goddard.
Welcome back to the show, John.
Jim, pleasure to be back on the show.
John, what does it mean for resource juniors if the global economy splits into autocracies led by China, Russia, and democracies led by the United States and Europe?
Jim, I think it is not a question of if, but when this happens. And when it happens, it will unleash the biggest bull market for resource juniors that we have ever seen. In our first Kaiser Watch episode on January 19th, which was before Putin invaded the Ukraine, I provided a graphic that showed 44 metals that I track. It showed what the combined output of China and Russia was, and that is just absolutely staggering. Of those 44 metals, 15 of them, they produce more than 50% of global supply. And another 9 of them, they produce 25 to 50% of global supply. Now, since our first episode, Russia has indeed invaded the Ukraine, and Putin clearly miscalculated about how easy it would be to walk in and take over. We're now 1 month into the invasion, and it is not going well for the Russians. And in the background, we've had this unnerving problem where China has refused to condemn the invasion. In fact, Russia has apparently asked China for material and military support. Last Friday, President Biden had a 2-hour conversation with President Xi Jinping about this issue. And apparently he threatened a vague threats of consequences should China indeed forge this alliance with Russia. And it's hard to imagine what that might be. But staring in our face is Taiwan. And Taiwan is a democracy. And of course the world really doesn't care about that. But what it does care about is that a majority of chip-making capacity is based in Taiwan. And China itself now has a COVID pandemic problem. The BA.2 variant, which is 50% more contagious than Omicron, it is now loose in mainland China. And they've had their zero COVID policy for the past 2 years. If they continue to do that, it will disrupt supply chains even worse than they have already been disrupted by the last couple years. So President Biden has this problem now where interest rates are rising. It's supposed to subdue inflation, but with further supply disruptions coming from China as a result of their domestic COVID policy, we're going to see a very unhappy population, seeing higher interest rates, plus inflation that keeps going up, and shortages of goods in the stores that come primarily from China. And that's a very good way for a president to lose his whatever slim control of the Senate and the House, and to basically hand control over the destiny of the United States to the Republicans, who appear to be in the pocket of Donald Trump, who himself appears to be a wannabe autocrat in the pocket of Putin. So this is a situation where Biden's pushed into a corner. So how does he deal with this potential problem that Xi Jinping aligns China with Russia and squares off against the rest of the global economy? Now, on April 1st, the Europeans, who are very unhappy about Russia and very concerned that Russia's ambitions are not going to stop at the Ukraine, they have a meeting with the European Union is having a meeting with China about relationships, economic relationships. And a big discussion topic will be, why are you not condemning this invasion of a democracy in our backyard? Now, everything has gone so badly for Russia in Ukraine. It has unleashed so much destruction that there really are only two outcomes for Russia. One is that Putin gets overthrown and the country undergoes some sort of reform and backs off from this near Russia vision that Putin has been pursuing. The other is that Russia somehow stops pushing into Ukraine, but settles in as a hostile autocracy and aligns itself with China. And China doesn't like the first option because that leaves it stranded as the only major autocracy out there dealing with the rest of the world, which is extremely unhappy with China's shift to a police state instead of the direction of a democracy that everybody had hoped. So my suspicion is that whatever it is that Biden threatened, it had something to do with Taiwan. And one thing that the United States could do is recognize Taiwan as an independent nation rather than continue this farce that Nixon unleashed in the early 70s when he started the repairing relationship between China and the United States. And this would, of course, cause a lot of trouble with China, but we already have trouble coming in the form of the COVID response supply disruptions that are coming. So what does Biden have to lose? And he can pretty much tell China that this is no longer about ideology, about democracy versus autocracy. We have an important stake in the semiconductor capacity of Taiwan. Yes, we in Europe and in the United States are building new foundries, but they are going to take 3 to 5 years to be finished. So we cannot afford to have your alliance with Russia possibly result in your invasion of Taiwan and jeopardize a major foundation to our Western economy. So we're going to step up our support for Taiwan. And what are you going to do about it? Suddenly withdraw all your supply to us, which hurts you even worse than it hurts us, and which you're already hurting yourself by with your zero COVID policy. So I suspect something like that was going on in the background. And Xi Jinping may say, yeah, okay, bring it on. We're going to carve up this world into 2 distinct economies, autocracies trading with themselves and democracies trading with themselves. And that is a huge problem for the democracies because of their dependence on Russian and Chinese raw material supply. So I think when this happens, you're going to see the resource juniors take off because the priority will be we need to replace this unreliable supply of metals, raw materials from China and Russia with domestic sources or in more secure jurisdictions closer to home. And it's not going to happen in places like Canada and the United States by launching expensive exploration programs that look deep undercover, looking for world-class deposits such as, say, the Resolution copper deposit in Arizona, because that takes too long. The shortfall in supply from China and Russia is going to have to be made up by the small to medium-sized deposits and systems that are already known in these regions and which the juniors are specialists in exploring and advancing. So it's going to turn into a major scramble to explore and advance existing mineralized systems and turn them into small to medium-sized mines that fill the gap, the supply gap that's going to emerge when the world splits into autocracy and democracy-based trading systems.
Verde Agritech released its financial results for 2021. What did we learn?
Well, their actual results came in slightly better than what they had guided. They sold 400,000 tons of K Forte last year. That generated $27.7 million revenue for a net profit of $3.5 million, or about 6.5 cents per fully diluted share. Now, the stock is now sort of around the $9 per share level, and the question is, okay, is this pricing justified? Well, they have guided 700,000 tons of production for 2022. But what's interesting in the press release they put out this week is that they say these assumptions do not include the 2.5 million ton mining concession grant that we got in January. And they've further guided that the Plant 1 will be commercially operational by Q3 of this year, which, if you use language strictly, that means July 1st it will be producing. That means the 1.2 million ton capacity that will be available from that is 600,000 tons of that could conceivably be produced during the second half of this year. And a couple of weeks ago, they also announced that they're going to double the capacity of Plant 2 to 2.4 million, and they've now guided that this should be operational by Q4, which means October 1st, which means another 300,000 tons. Now, the planting season runs from sort of May through August, and so the farmers will have wanted all the materials by then. But given the situation now where Belarusian and Russian potash is not leaving their shores going anywhere, and KCL landed in Brazil is now over $1,000 per ton, we are not going to see this situation happen where they wait last minute to place the orders. We're going to see orders placed throughout the year to prepare for next year, because the Russian situation now is so bad, there is no conceivable positive resolution in the short term. Dealing with this problem, assuming it doesn't escalate to a nuclear confrontation, in which case nothing really matters anymore, this will take at least well into next year to resolve itself and have potash supply return to some sort of normal level. So if you add up this extra capacity, and they are correct in their predictions as to when the processing capacity will be available, we're looking at a potential doubling from 700,000 tons output next year, or this year, to 1.4 million tons, which is sort of what they were guiding for 2023 before they announced their doubling. They're now guiding the full 3 million for next year because they will have everything operational by the end of this year. So the question becomes, in this best case scenario, what do the potential financials look like for this year? Now, their guidance was $72 million Canadian revenue for 700,000 tons this year, generating about 28.4 million EBITDA, and this would translate. If you basically double this, you end up having 144 million revenue and $57 million EBITDA, which translates into $1.05 per share. But these numbers that they have guided are based on $500 a ton KCL, when the reality right now is over $1,000 per ton. Now, they have suggested that they will not follow the potash price, which conceivably could spike to $1,500, $2,000 a ton later this year as this Ukraine-Russia crisis drags on and all the ships have delivered their cargo. And there's even like a strike happening in Canada, CP rail workers, and that apparently moves 70% of Canada's potash to the coast. So there could be a disruption down the road from that sends prices way up. But if the company sticks with this idea, we're not going to maintain our parity pricing policy in this crisis situation. We're going to keep it at the sort of level that prevailed before the Russian invasion, which was around $900 a ton, and we're going to charge that rather than $1,500 or whatever. You use this to gain market share rather than gain profitability for this year, a short-lived windfall profit. We want to build the adoption of K40 as an alternative to imported KCL. So if we use that number, that's an 180% higher number. So we could conceivably boost our the figures. It would jump to 260 million revenues, and because the costs are unaffected by that pricing, that would translate into a staggering $173 million of EBITDA, or about $3 something per share. And that's a staggering number. So the best case scenario, if everything unfolds as they are hinting at, the upward guidance will be significant, and this stock, which is now at $9, would end up being trading at sort of three times EBITDA, and it should be trading 10 times that. And so we're looking at, easily the stock hitting $20 to $30 later this year if all this comes to pass. But the other interesting thing that they guided in the update about the financials was they are working on a new pre-feasibility study, and these pre-feasibility studies are needed for the mining concession grants. It's part of the permitting cycle. Brazil wants to see the economic foundation for an application to develop a mine that's separate from the environmental permitting cycle, which has to do how the mine will impact the environment. But they want both of those to be positive, not have a negative impact on the environment, and actually have a positive economic impact. And in this updated PFS, and they haven't said when they will release this, they are now talking about including a scenario of 50 million tons per annum of production. That's double the $25 million that they used, million tons that they used in the earlier PFS. That was the basis for the mining grant concession. And talking to Chris Veloso, he has suggested that, 10 million tons a year is the logistical limit for delivering the K4 to the farmers by truck. There's just not enough road capacity. To go beyond 10 million and say all the way to 50 million, we're talking about building rail infrastructure. We're talking about billions of dollars of capex. This is the sort of thing that the giant companies such as Vale, other Brazilian companies, this is what they would become involved in. So in putting this into the PFS, this growth scenario, they're making a case to the politicians, to the capital markets, to the big players in Brazil that Brazil's problems with the potash import vulnerability can be partially solved. And at 50 million tons per year, and remember, that's 1/6 of that is equivalent of potassium chloride. That would be 63% of Brazil's 2021 consumption. Not a total solution, but a very significant partial solution. Right now, they're only going to do a fraction of that with their expansion plans this year, but people can see the numbers, they can see the crisis, and they can see the need to develop a long-term solution. So once this pre-feasibility study is released, there's going to be a lot of eyeballs looking at it and saying, wow, this company needs to be supported. And that's why I think it's not an implausible conjecture to see a future $50 to $100 price for Verde Agritech as all this starts to unfold, and everybody gets serious about using K-Forte as an alternative to potassium chloride. And something that's also occurred to me when I was last super excited about this company was in 2010 to 2012 when they were working on the Cambridge process for converting the glauconite into conventional potassium chloride. And that was supposed to be a bankable feasibility study, but they couldn't get the bankable stamp because the scale of pilot plant studies needed to allow the scale of equipment that they were going to purchase, it was supposed to be bigger. So the bankable stamp was missing. It also required $400 KCL to be viable. The additional study would have cost $20 million. By then, potassium chloride was falling. Eventually, it's dropped below $300, and then it became moot because the the project just wasn't going to work with, potash back in the $200 to $300 per ton range. But an option for this company, if we are stuck with a long-term scenario of elevated potash prices, what stops the company from getting into the $10 to $15 per share range, and all of a sudden you have these big ag funds come up and say, we'd like to take a position in the company, but we don't need the money. We can do this with cheap loans and from cash flow. Yes, but how about $20 million, 2 million shares issued to spend to see if this KCl process works? Because then you have a situation where, for example, the coffee farmers, they need 3 times as much potassium chloride as other crops. So when you add the fact that you have to deliver 6 times the volume to use K4, that starts looking not so viable, especially if oil prices end up staying persistently high. So maybe making conventional KCl can be done in parallel with making the K4, grinding it up and delivering it to the farmers. And this would be a stunning development if the company goes full circle to revisit the Cambridge process to make conventional potassium chloride, in addition to transforming the usage of farmers of KCl to the K4 product, which is much less harmful to the soil than is the conventional potassium chloride, whose salt tends to kill the microorganisms in the soil, which are critical to plant uptake of all sorts of other nutrients in the soil. So this press release, when it came out, confirmed the guidance, showed that they're managing their expectations nicely. They're delivering, over-delivering what they're promising. But it's also set the stage for higher guidance later this year. And while the tragedy in Ukraine is extremely unfortunate, one benefit of it is that it is forcing Brazil to deal with what was always going to be a long-term problem, which was its dependency on importing potash from other parts of the world, especially given that Brazil is one of the major agricultural growing regions of the world.
The market had a negative reaction last week when Eskay Mining surprised us with final drill results for the 2021 season in the Eskay project in the Golden Triangle. On Monday, the stock was halted for additional news. Why was the stock halted?
Well, Jim, last week we addressed the press release that came out. It summed up all the drill results for last year, the final results. But what was missing was any sort of discussion about what's next. And the market, the news just came out in the morning, and the stock promptly dropped 50 cents. And one of the things that the market was able to see was that about 100 holes have Swiss cheese, the TV, and Jeff zones, which have decent gold-silver grades, but not on a par with the 21B zone. And certainly the footprint that they drilled, the tonnage footprint was considerably smaller than the 2.5 million ton 21B zone that is now mined out. And so the market realized, well, they really haven't accomplished much in terms of demonstrating that we have a future VMS deposit mine on this project. And that was the reason for the draw. On Monday, why did they halt it? I'm not sure why they halted it. At first I thought it was to announce a financing, but the halt was to give people a chance to read a follow-up news release which describes what was accomplished through the target development work the past summer. And the stock only lost a few pennies on that, but now my optimism has been restored. Last week I was a bit bummed out. I said, okay, we've spent all this money. We have these 2 small zones. They are not 21B zones. You do need to raise money for a major program at least similar scale as last year. So what are we going to do? Well, this press release now outlines what's going on, and it deals with additional SkyTem targets that they've developed in the vicinity of the TV and Jeff zones, and these are on the eastern limb of the Eskay anticline, and they will start drilling, sort of grid drilling in these areas of these targets, stepping well beyond the TV and Jeff zones, start expanding them along the strike of the stratigraphy, and hopefully start finding additional mineralization that they can then focus and build up the tonnage footprint of this system. One of the especially intriguing things to come out of this press release was the Excelsior target area. And this is west of the TV area on the west flank of the Eskay anticline. And there they have similar geochemistry in the soil as in the TV area, but what they have observed in the field is that the rock in that area is the upper stratigraphy in the sequence that constitutes this former marine base, and that was the focus of all these VMS systems. And the 21B zone is basically at the top of the final horizon before the whole system got paved over with basalt and then even further buried by the Bowser Lake sediments. So this is important because what they've established is that there have been multiple periods of VMS hydrothermal activity, and of course they could only go up as far as whatever level horizon was under sea at the moment. And what you really want is the last stages where it's gone through several perhaps previous systems and harvested older mineralization that has been laid down, remobilized it, and then redeposited it in that final gasp that created the fabulous 21B zone. So they are going to go back in there and do some more target development. I do not know if Excelsior will get a chance to be drilled this year, but it is an area that is very intriguing, and it is not that far from the TV Jeff area where the initial drilling will be focused. The discussion of the C10 Vermilion Spearhead is a bit of a letdown. When you hear stuff like, we're going to have a boots in the field exploration, boots on the ground field exploration season, that means they're not quite sure where the targets are. And given this part of the property's location and difficult terrain, it's guaranteed at this point that there will not be any drills turning. The area that I've been waiting for is an update on the Scarlet Ridge area, and I was disappointed to hear that the chip sampling that they got done, only a few of them got some interesting values, but it turns out that they had not much time to collect chip samples before the snow chased them out, but they did spend a lot of work in the field comparing the historical data that they've dug up, and much of that was generated back in the day when the Eskay Creek deposit was discovered, so it was not well understood. Nobody quite knew what to make of anything. Today there is a far more sophisticated understanding of what makes this whole VMS basin tick, and they have a number of conductive targets in this area. They plan to get their crews in there right as soon as they can in July and develop these targets and have them ready for drilling in the fall. So we're going to see two major waves of drilling this year. The first will be in the TV Jeff area to knock off all those SkyTem targets and see how many of these VMS feeder systems are in that area. We will see Scarlet Ridge drilling, and this is to the east of the Eskay Creek deposit itself, in an area where there's a very big leg gold anomaly that has never been explained, and also the stratigraphy that they're dealing with there is the upper part of the sequence. So again, we're dealing with Eskay Creek horizon type stratigraphy, and maybe we will also see some drilling going on in the Excelsior area to the west of the TV Jeff area. The TV Jeff zones themselves, they have not yet found the younger horizons that are the equivalent of the Eskay Creek 21B zone. So if they were to get some holes in on the western flank in the Excelsior area, they could get lucky late in the season if they are able to swing some drills over there on targets that they've developed this year. So my optimism that 2022 is going to be a great year for Eskay Mining is restored. Now we're waiting for the next important milestone, which is a financing that gives them the money to do this program, which will finally be focused on generating brand new discoveries and confirming the hypothesis that this is going to be an area with multiple gold, silver rich VMS clusters.
John, thank you so much for the update.
You're welcome, Jim.
I'm Jim Goddard.
Comments made on Kaiser Watch are an expression of opinion only and should not be construed in any manner whatsoever as a recommendation to buy or sell any financial instrument at any time. Archived online at kaiserresearch.com.